Presidential Wealth Management. Is gold just a refuge for apocalyptic warriors? Or is it a domain for serious investors looking to diversify their portfolios? Taylor Leary flies solo on this Eagle's Nest webcast to discover and share insights on gold and other precious metals. If you're wondering how gold might fit into your portfolio, you'll appreciate this headfirst dive into the deep end to help you better understand gold as an asset class and what you need to know as an investor.
Unless you've been hiding under a rock, holding on to your gold nuggets, you've seen what's been going on in gold recently. And if you're one of those gold bugs, this has you doing the jitterbug. Since taking a big plunge in March, gold prices are setting record highs, it seems like day after day. As the gold bugs rejoice and the market has finally come around and become relevant, after total collapse in 2012, it's time to take a look at what's going on. So move over, big tech. There's another darling in the building. There are many possible reasons for the meteoric rise in gold prices. And for that matter, most precious metals. We've seen silver and copper go to ultimate all-time highs over the last several months. Could it be that people are responding to the flood of money being pumped into the system, not only in the United States, but worldwide, to combat economic collapse? Or is it possibly the social underlying social unrest that we've seen? Or possibly others are fearful of the upcoming election here in the United States. In any case, gold has made a massive revival. Since early June, investors have been calling and emailing me to ask how gold might fit into their portfolio. And if you've joined us today, I hope I can do my best to glean some light on gold as an asset class and gold, how it might fit for you as an investor. Today, I will take you on a deep dive in what's going on in the precious metals market. And again, do my best to shine up your investment knowledge of gold and other precious metals. In today's conversation, we're going to be putting some context to the latest market move, telling you how to access or how you could access precious metals as an asset class, some of the challenges owning precious metals, and then what are some other risks that you should consider if you decide to become an investor or you're already an investor in gold. And then finally, understanding how gold fits into your overall portfolio. My name is Taylor Leary. I'm a certified financial planner and wealth advisor with Presidential Wealth Management, and I'm excited to be, I guess, the only one on the show today. I usually have Keith with me, but I'm riding solo today, and I'm very excited to dive into it. But before we go there, I want to do a few housekeeping items so you can get the most out of today's presentation. As you'll notice, there are a few options on the bars to the right, and the first one is going to be the chat box. So the chat feature is a tremendous way to get in touch with me as we go through this conversation. So we've kept this as a private message system. So it's not going to be public. I always like to keep it that way in case people feel a little bit, have a little trepidation, if you will, about asking questions, because a lot of people might feel silly about their questions, but I guarantee that the question that you have, many others have the exact same question. So use the chat feature to ask your questions directly of me. And if you're watching this after 2 o'clock on Thursday, August 20th, you can use that chat feature as a way, and it will actually get emailed directly to me. So again, if you're live, you can use the chat feature right now. If it's not live, then what you can do is use the same chat feature and those questions will be emailed directly to me. I also want to point out the polls. So the polls is a great way to do get immediate gratification on my end on questions that I have. So I actually have a few questions for the audience today, and I want to get your feedback as we go through these questions and understanding how gold is going to work for you. And then finally, I want to point out the offers tab. The offers tab is a great way to get in touch with myself or another advisor with Presidential Wealth Management. As I mentioned about investing in gold and understanding how it works in the context of your portfolio, this would be a great time to schedule a one-on-one consultation or a one-on-one call with one of our advisors to understand if gold is the right fit for you, whether you should have more of it, whether you should have less of it, or add it to your portfolio. There are a host of questions that I'm sure individuals might have, and providing context to your overall financial picture is incredibly important. So don't just think about this as a vacuum asset class or one tiny little piece. Think of it in the context of things. And if you have questions regarding how gold fits into your plan, use the offers tab, which I'll refer to throughout this presentation today, to connect with us. That'll take you to our website, plug in a little bit of information about who you are and how to connect with you, and we'll be sure to get in touch. So with that, I'm going to dive right in to the start of the presentation. As I've mentioned, gold bugs are rejoicing. I got an email just a week or two ago from a client of mine, and he was one of the gold bugs back in 2011 and 2012 and bought gold, and it was buying it on the high. And since that time, things have not looked very good for his portfolio in that particular context. However, he sent me an email to remind me how right he is today. And hey, with that, I will give him and applaud him that absolutely gold has come back around. Things are looking good. And it's definitely good to see that we're seeing gold rebound. But there's a lot of context to that. So let's just jump right into that. Or I guess before we do that, we'll look at where did this rally come from? How to own gold. So what are the different vehicles that you can have, that you can own as a way to access, the going up and down of gold prices, and then risks that you should consider when owning gold or precious metals. And then finally, where does gold fit into your portfolio? So those four areas are going to be what I touch on today. And I want to make one minor point here, or a parenthetical piece here, and that is, when I say gold, I'm kind of lumping precious metals in the context of this. So what I mean by that is, silver, copper, gold, other precious metals that you would consider investing in. And I'm just going to use gold as kind of the catch-all phrase. But understand, when I say gold, I kind of mean the entire precious metals market. But since gold is kind of the most popular and easiest to see, if you go to CNBC, it's all going to be there. I'm going to use gold as my proxy for what's going on. But all the other markets in the precious metal space have done really good. Palladium, platinum, silver, copper, they've all done really, really well. But before we get into the actual meat and potatoes, I do have my very first poll question that I want to ask you. The first is, and I'm publishing that right now, is, are you invested in gold or other precious metals? Yes, no, or thinking about it. I'll leave that up for a few minutes. I'd love to hear what you have, or if you are currently invested in gold, and where you are, if you're invested, if you're not invested, or potentially thinking about it. These are all great things. So we're starting to first get our first few responses, and it does look like some people out there do have some gold, and then some other people are thinking about it. So let's put some context to what's going on. Now, this is going back to basically the last 10 years. So since 2010, what we've seen. Now, I want to point out here that in the initial phase, so going up through 2010 and 2011, 2012, if you'll remember, this is when we saw a massive increase in our monetary policy. So this was when the QE, or the quantitative easing, really was hitting its stride. And if you'll remember, Ben Bernanke was doing this to essentially pump up the market. So we're coming out of the bottom of 2008, 2009, where the housing market completely collapsed, and we're seeing houses go into default or foreclosure, and we're just seeing a huge challenge to the financial markets. And so during that period of time, quantitative easing was pumping money, historic amounts of money, into the market. And that was one of the reasons. So my question of why does gold go up in various times? Now, I want to point out that this is an absolute price, not inflation adjusted. I will show you a screen here, the inflation adjusted price of gold relative to today's value. This is the absolute value of a price of an ounce of gold. And right now you see that back in 2011, 2012, we hit 1800. And that was always kind of that ceiling that we were trying to hit. Now, I do want to point out that over on the far end of the curve here, and that is where the gray area is. So that's technically where a recession has occurred. So that is essentially where we're saying that, COVID hit us, and that was really a recessionary environment. We're now in a recessionary environment. And oftentimes you see during recessions, gold prices go up. There was something that I came across. It was a quote off of CNBC, and it said, "Gold is possibly the most emotionally driven asset class, the refuge of apocalyptic warriors, as well as serious traders who look at it as a portfolio diversifier and alternative to paper currency." And that actually points out exactly what we're talking about here. And that is this historical context of why this asset class just has, all of a sudden these boom and bust moments. And so you'll notice that in early 2012, or I guess through 2010 through 2012, we saw this massive rise up in the price of gold. But then through 2012, or at the end of 2012, we saw this big tanking, and it dropped and dropped and dropped. And then we saw the bottom there in 2016 timeframe. And that was really where we saw an expansionary environment in our economy. And basically the economy and kind of our country was like, we took a big sigh of relief. We said, oh man, we got over that. So you'll oftentimes see that gold is a non-correlated asset class. Year to date it's up 26%. So that's doing really well. There was a bit of a hiccup, as I mentioned, in March, but we have seen a pretty tremendous rise through the early parts of 2020. And then we saw that pullback, and then we've seen that increase again over the last several months. Now, a lot of things are going on in the market right now, and it's kind of been a wild ride. Earlier, if you go back to one of my first webcasts, and that was in early April, I was talking about kind of the dislocation in the market, especially the dislocation in the stock market and the bond market. So we saw that stocks were kind of going haywire. We've seen the tech world just absolutely explode over the last 3 or 4 months. And during that period of time, we saw bonds really react strangely as well. We saw very high quality, good credit bonds get priced down significantly, and then they saw a meteoric rise in that early part of April and May, and that's rebounded quite well. Well, since that time, we've also seen gold rise right along with it. So we're seeing all three asset classes, and you kind of take those three as kind of these bigger picture, these macro asset classes. You've got your your commodities, which is exactly what gold is, and then you have your stocks, and then you have your bonds. And very rarely do you see them all move either to the same upside or to the downside together. So there's a lot of things that are going on right now, but I would say that there's a high likelihood that individuals are flooding in to the gold market, whether that's the asset classes, which we'll get to here in a moment, as far as how to access gold as an investment. But it's very interesting. I think that there's a lot of concern right now. I think when you see the volatility index go to a high, I think that there's a positive correlation to gold prices, and then the VIX, as they call it, the volatility or the fear index. And so when you see that people are fearful, gold is oftentimes one of those places of safety or perceived safety, especially when it comes to inflation and potential for monetary collapse. So right now we're seeing a massive flood all the time. I mean, it seems like every day we're anticipating probably another huge stimulus package that's going to come out of Congress over the next coming weeks. We've seen the Fed prop up the market. We've seen Congress already do the first round there after the CARES Act. And again, we're probably going to see the CARES Act 2.0 or Stimulus 2.0 here in the coming weeks. So I just want to jump back in. It looks like about 66% of the people actually own gold or are exposed to gold as an asset class. We've got some people that are thinking about it, and very rarely or very few people are actually have no gold as part of their portfolio. Very interesting numbers. Definitely, certainly something to consider. I'm actually going to shut off that poll right now, and I'm just going to jump over to the chat box. As a reminder, use the chat box to ask any questions. I'll do my best to answer those questions on the fly as we go, or I might wait till the end to hold off. If they are very personal in nature, if it's very specific to your situation, I'll make sure that maybe we can jump offline or somehow connect offline, and I'd be happy to answer those questions. But I want to jump in and show you the inflation-adjusted price going back 100 years of gold. And you'll see that, these, things fluctuate over time. But I want to just put context to it, and that is, back in the 30s, we saw the inflation-adjusted price get almost to that $800 level. They're more like $700 an ounce. But then you've seen things fly over time. And this is going to be, again, with those bars being various times in history that we've seen recessions or things like that. You'll notice that on the far right side of the graph, those big, huge bumps there, those are going to be the most recent last 10 years. So that's going to be more like the graph that I showed you before. But what's interesting is that from an inflation-adjusted perspective, back in the late 70s, actually was a record high for gold relative to inflation and kind of adjusted for today's prices. So kind of interesting that we've seen fluctuations over time. And you'll see, again, just expansionary moments where gold hasn't done quite as well, or it's just not quite as strong of an asset class. So again, understanding context and taking these decisions from an investment, kind of in a holistic investment approach is very important, because just owning gold to own gold, you're going to see a lot of volatility, which I'm going to talk about some of those risks here in a moment. Now, there's a bunch of ways to own gold. The first is to own the physical asset. So there's a number of ways that you can do this. The first way is you could actually go to the government, and they have hoards and hoards and hoards of gold. And you could buy gold from the government. You could also buy it from a dealer. This could come into the big brick, that really cool brick. I would love to actually own a brick of gold, just to have it. I think it'd be kind of cool. But you could also own that by way of jewelry. That's another way to have access to gold. But when you buy gold, the physical thing, there's some pros to it. Number one, there's that emotional element, and that is you can hold on it. You can chew on it. I mean, you could quite literally, put your teeth on that thing. You could put it in your hand. You can feel the weight, and you can really understand that you own this asset. And it's something that you can kind of put under your, quite literally put under your pillow, or you could go bury it in the backyard if that's what you want to do. So there are some pros to owning that, is that you actually own the physical thing. Now, we sometimes joke in our office that if you feel the need to own physical gold because it's going to be a way to have currency in the future, then it might be wise to own some bullets and a gun to go along with it. Because if we get to that environment, you're going to want to have a little bit more protection than maybe just having the gold in your pocket. And we say that obviously tongue in cheek, but there are some limitations to owning gold. The first is, just making sure that it's reputable, that it's actually of good quality. There's something that I've found out, over the years of learning about gold and investing in that. And that is the difference between maybe a 10 karat gold or 24 karat gold. So they say that 24 karat gold, from a jewelry perspective, is going to be the purest form. It's the most pure form. And then also that from the perspective of owning like a gold bar, that's going to have the 0.99999 on there that you can actually see, feel, touch, hold. I was given a little silver coin here not too long ago, and it's 0.999 ounce of silver, which is really cool. I mean, I guess that's worth something these days. But the idea of owning the physical thing is there are some challenges on top of it being, you make sure that it's actually a good piece of either jewelry or the actual gold bar. Is number one, sourcing it. So if you want to buy the gold bar, you got to find somebody that's, again, a reputable dealer, or somebody that can broker the deal to buy the actual physical metal. The other part is storing it. Now, if it's gold jewelry, you can wear it, but that, then you run the risk of potentially losing it or something like that. You could put it in a safe at your home. But if you own any significant amount of gold or gold bars or gold bullion or something like that, you've got to think about what you do with that. Where do you put it? Do you bury it in the backyard, not tell anybody, or write it in a note? I mean, there's a lot of ways, but there's also places, safe deposit boxes. But in today's world, the safe deposit box is real small, and there's going to be some costs to actually owning it. So you might have to pay somebody to physically hold your gold. So that's something to consider as well. And then the other side is the liquidity factor, is that if you go to sell your gold, are you going to get the actual market value? Oftentimes when we see somebody selling, especially fire selling something, maybe they're not selling in the best market, and there's going to be a bit of a difference between what you want for it, or the market price, and then what you're getting for it. The bid asks, there could be a delta there that you want to consider. And so the liquidity thing is definitely something that you should consider as it relates to owning the physical asset. Is how do you get rid of it? Who will buy this thing? Is there a readily available market to have this gold on hand? The second one is going to own gold miner stock, or buy into a mining company. So there are a whole host of individual companies out there that are mining gold. They're probably mining a lot of other things on top of just gold, but they have big mines that they're doing it, whatever if that is something that you want to do, then absolutely you want to take advantage of it. Now, I will say that for those people that are really thinking about the environment and things like that, owning gold miners might actually go against what you really want to think about, or what you stand for. So kind of consider that when you're buying into that. Is how do you feel about the industry? There's a lot of folks that come to me and they say, you know what, Taylor, I don't want to own companies that are into maybe cigarettes or guns or something like that. And then there are some people that have come to me and they say, we want to invest in people that are environmentally conscious. Well, I would have to say that the gold miners, are really probably not necessarily going to fit that. So if that's something that you're concerned about, which has become really popular in this day and age, maybe that's not the best way to approach it. The other thing about owning gold miners is that you have to be concerned about their business model and how they do business. Now, I say that because you've got to worry about so you get the risk, if you will, of owning any random company. You've got to make sure that they've got strong balance sheet, that they have good management, that their business model and structure works. That's something that you have to kind of look at on an individual basis. And then the other factor is you also have to have them tied to the price of gold, because what happens is that if gold goes up, these miners do really well, but if gold goes down, they also go down. So kind of think about it in the same way that you might consider an oil and gas company as an example. As the price of gas goes up, well, the price of those companies likely goes up. If the price goes down, well, we saw that earlier this year, that we saw ExxonMobil, some of those large oil and gas companies go down. So owning the gold miner stocks is a great way to access a proxy for gold if you don't want to own the individual asset class. Because what you can see is that some companies are really well run. That's the other aspect, is that you have to consider not only how the business is run, but also what their extraction rate is. What are their gold deposits? What's the future of the land or the mine that they own? Because if it's coming up on the end of its life, that's the thing about gold. Gold is a finite asset. That's why it's so valuable, and it's very hard to get to. It's very hard to find, and then you've got to be able to have the right tools and resources to actually get it out of the ground. So with that said, those are some of the challenges to owning the gold miners. On the flip side, owning a stock is a very easy thing to do. You can go out there. There's not a lot of friction to owning the individual miner stock. And so with that said, that would be one approach. There's also another way that you can access the gold miners is through like a fund or an ETF, where they actually go out and invest through a fund various gold miners. So you can get a diversified portfolio of those gold mining stocks, or the companies inside of one fund. So you have a little bit of diversification. So you don't necessarily have to go to the stable and get the best horse. You could just buy the whole stable. So I want to just jump quickly and answer a couple of questions. Linda, what about buying the actual coins? You didn't mention that. Okay. Well, again, physical gold is what I was talking about. You can go out and buy the bars of gold or the coins. There's a number of ways that you can do it. If you buy the bar, I think you're buying, a large quantity. By buying the coins, then you can break that down into smaller amounts. So the cost of acquisition or the cost of ownership actually goes down because you don't have to buy so much in bulk. I'm going to jump to Larry here. Is anyone expecting a resurgence of inflation within the next 5 years? Larry, I'm going to jump to that question here in a minute to talk about some of the risks associated to it. But I think that's a fantastic question. So thank you so much for asking that. I'll get to that here in a minute. I'm going to go to the third way. And again, there's a couple of other ways that you can own gold, but there's kind of those three approaches: the physical gold, the miners, and then the ETF, okay, or exchange traded fund or another mutual fund or something like that. And this can be a great way. So I'm just going to use as a proxy or as an example, GLD. That's the ticker symbol for the gold ETF. Again, I'm going to put this out there. I'm not suggesting that you buy that. However, we're going to talk about that because that's a very, very popular way to access gold as an asset class. Now, with ETFs or a fund, a mutual fund that tracks the price of gold, because that's essentially what the ETF is doing. They have some gold on the back end, but they're tracking, and it's going in lockstep with the price of gold. I think that personally, if you're going to be invested in gold, and this is something that you feel strongly about, might be the best way to do it. I'm not suggesting that you've got to buy GLD, but using more of the indexed approach oftentimes is because you really want to have access. Most people want access to gold because of the fluctuation in price, the non-correlation to the market, things of that nature. And so with that, the ETF can be a fantastic way to do it. I will, however, point out that some of the negatives of doing that is that because it's so frictionless, you see a lot of volatility in the price. So you can see things going up and down. And when I say frictionless, what I want to kind of just point out or at least bring to light is this idea of selling your house. To sell your home there's a lot of friction in that transaction. So when I say frictionless, that means that it's very easy to buy and sell, and therefore emotions start to creep in and become a part of that decision-making process. So the other side of that, though, is that with buying the ETF or buying a fund that tracks the price of gold, you don't have to actually own the physical asset. So you don't have to custodian or hold it somewhere. You don't have to, you're not exposed to a business model or bad management or something like that, or you're not really concerned about whether they have good deposits or their extraction rates high or low or whatever the case is. So owning the index can be a fantastic way to access the price of gold or as an asset class. So with that, you don't have to have a lot to buy in. You can buy fractional shares. You can buy a large amount, you buy a small amount, you can add, you can subtract. There's a whole host. So there's a lot of flexibility in owning that. But again, that's using a little bit of bias on my end, because that's oftentimes how, if a client comes to me and wants to own gold, that's typically the way that I would do it for a client. However, if you have another avenue, fantastic. That's certainly your prerogative. But I say that, you know, owning the ETF or a fund that tracks the price of gold is a great way to access the asset class as a whole. I'm sorry, I'm just reading the chat feature. You know, I'm not sure on the legality of buying and selling. I do know that if you go through the government, or if you want to buy some gold, you can actually go to the government website, and they actually have legitimate brokers. Because again, there's a lot of the sign flippers and things like that. I'm sure we're going to start to see more and more of that. So just be aware of buying the physical gold. I mean, that's all. You got to know that, you know, it's through a credible source, and that you're getting it from you know, high quality stuff. So risks to consider. Now, I've kind of alluded to this both with you know, how to buy them or how to access gold, but within the risks, I just want to kind of touch on this. So the first is going to be volatility. Now, I showed you that screen, and actually I'm going to go back to it. If you'll give me just a moment, the inflation adjusted price. Now, again, this is a little bit of a jagged curve, but in the reality is that there's massive amounts of volatility in the price of gold, and largely driven by the fact that it's a commodity, and it's kind of a boom or bust. But volatility is one of those things that oftentimes is something that people don't think about, but volatility can be a very detrimental element to investing, because it's those emotional highs and lows. And the more our emotions get tied to our investments, the more likely we are to make poor decisions. And so with that, you've got to be aware of some of the risks that are associated to it. One being volatility. If you've got big ups and downs where, and you can't really stomach the volatility, then maybe you ought to consider getting off the ride. I always kind of say that if you go to the theme park and you want you can't handle the loop-de-loops, then maybe it's probably not a good place for you. But if you're okay with the ride and kind of okay with holding on to it for a long time, or you know, buying it and getting out of it, those are certainly some things. I'm not a big fan of trying to time the market. I think it's been proven time and time again that timing the market over a long period of time really doesn't produce solid results. So we have to be very considerate of the volatility that it's related to gold as an asset class. I will also point out correlation. Now, correlation, you might say, well, why is that a risk? Well, the risk or that's inside correlation is that oftentimes when people buy gold, it's usually because the price has gone up. And as I mentioned earlier, it's typically a non-correlated asset class. So when stocks and bonds are moving up or down, it's going in the opposite direction. So it's not moving in lockstep with other asset classes like stocks or bonds. And so with that being said, you kind of have to understand your investment objective. So these are all going to be kind of tied together in some respects, but the fact that it can be a non-correlated asset can actually have a drag effect on your return. And so you have to be considerate of that. You know, if we go back to what happened in 2019. 2019 was a tremendously good year for stocks. We saw the S&P and the Dow up nearly 30% in 2019. That was a fantastic year for the stocks. But we know that the price of gold was not up nearly like that. So with that said, some people might look at that and say, that's a bad part of my portfolio and I'm going to get rid of it. Well, only to have it just have a meteoric rise over the last few months. Again, considering emotion as it relates to the investment absolutely should be considered. But the fact that it's a non-correlated asset doesn't mean that even in good years of the stock market, and maybe it doesn't do quite as well, you shouldn't just get rid of it, off of the emotional reaction to it. So consider that, how it correlates to the market or doesn't correlate, because it can be a great thing to buoy your portfolio if we have a down year. Again, something to consider. It has a very boom and bust type of profile. Now, this is a little bit different than volatility. When I think of volatility, I'm thinking of kind of the day-to-day, week-to-week, month-to-month type of ups and downs. We see kind of things go up and down pretty regularly, and gold prices tend to do that. However, with gold, we see this boom and bust approach where, again, I'm going to actually just go back to that inflation adjusted thing. You'll see that things expanded really heavily, and then they fell apart, and then they expanded. Now, I will also point out this right here. We saw in 2011, 2012, things were moving up, and then all of a sudden it peaked out in 2012 and started to ride down, and then it was a steady ride down through 2016, and then we've steadily kind of crept back up. Now, again, I'll just point that out because that really crushed a lot of people. And with a lot of people coming to me right now asking a lot about gold, it starts to make me wonder if history, as we know, history doesn't repeat itself, but it certainly rhymes. And so right now could be one of those moments where we reach that peak price of over $2,000, and then we come down from there. So again, this boom and bust approach is something that you should very much consider, because oftentimes, and this is something that we've talked about in other webcasts, and that is the various risks and sort of the headline risks, the biases that we have. Well, a lot of the times when we open up a CNBC or whatever the app that you use to track stocks, or your Wall Street Journal, a lot of the times, and most of the time, it's going to be the soup du jour, the news du jour of that day. And oftentimes it's what's going to get the most eyeballs. So understand that when Tesla's moving up, there's going to be a lot of news about Tesla. If the gold market's going up, there's going to be a lot of news about gold. So with that being said, we have to be very aware of the boom and bust profile that you have with gold. So we got to be very considerate of that as it is a part of your portfolio. And we'll kind of talk about that a bit more. Now, I say investment objectives as a risk to consider. And why I put that in there is very deliberately. And that's because if you've got to have the right reasons to be invested in gold. We talked about volatility, correlation, boom and bust, but a lot of the times if you don't have your why dialed in, and what I mean by is, why are you invested in gold? Why are you invested in real estate? Why are you invested in stocks? All of these things have a massive impact on the way that you treat some investments. So your investment objective absolutely matters as it relates to owning gold or other precious metals. Because if you don't buy it for the right reasons, then you're going to sell it for the wrong reasons as well. And so with that being said, that becomes an inherent risk to owning this as an asset class. If you're buying it because Bill down the street, who you think is a pretty good investor, bought it in his portfolio, well, he might be more of a gold bug. And we say gold bug because those are the people that really love gold and they're constantly adding it to their portfolio. But Bill might have insights and he might tell you to buy it. That's the best thing that you can own right now. But my guess is that Bill is not going to call you up the day that he's going to sell it. And so the whole idea is owning it because it works for you, not necessarily because it's the in vogue thing to do. So having the why behind the how, or knowing why you're going to invest in something is incredibly important as it relates to this investment. The other thing I'll say about investment objective is, if you own gold, the physical thing, it's a non-producing asset. And what I mean by that is that it doesn't pay you a dividend. Gold itself doesn't pay you a dividend. Now, there are some gold miners out there that do pay dividends, so that's a little bit of a different conversation. However, the physical asset or owning the ETF, they don't pay a dividend. And so if your investment objective, if you're in retirement or you're looking to create income at some level for your investments, Gold would not be a good reason to add that to your portfolio if you just want to own it. Now, again, knowing what the investment is going to do for you is absolutely imperative, because if you're buying it for the right reasons, you're going to own it even when it's not a popular investment. So that's the other side of that. So again, make sure that your investment objective and the reason why you're going to buy gold is made sound. If you don't know that, that's an opportunity for us to have a conversation. By all means, use the offer button to hit that. Check it out. Click that. You'll have a direct conversation with me. We can work out some of the understanding how it might fit in your portfolio, why it might not fit in your portfolio. There's a whole host of things that we can go through just in a very short time. And then the last thing that I'll say as far as risks to consider is that it's a commodity. At the end of the day, gold is a commodity, and it's going to act like a commodity. So it's going to be volatile. It's not going to be a correlated asset. It's going to have a boom and bust approach. And again, with the idea of owning it for the right reasons is also part of it. So remember that gold is a solid asset class if you want to own that, but you've got to do it in the right way with a lot of thought, and don't just make that decision in a silo. Consider it how it is as the overall portfolio strategy. So finally, we're going to get into where does it fit into your portfolio. I'd mentioned this heavily before, and that is know your why. Why are you invested? If you don't really have a very planned out investment strategy that incorporates protection, income, and growth, if you don't really understand, if you're the type of person that's out there buying a stock and doing this and just because it's fun, that might we really got to understand the why behind your portfolio strategy. And if you're just adding gold because it seems like the right thing to do, or that Warren Buffett bought into Barrick as a gold miner the other day, and that's why you're buying gold, then maybe we need to consider, or at least it's worth a conversation, because what happens is that you're going to be, you might be the type of individual that's coming in at the later stages of a rally. And so this boom is happening, boom, boom, things are happening, prices are going up, everybody's getting in this. In this day and age, I am a millennial, so I want to point this out. It's called the FOMO investment. And so sometimes it's this fear of missing out. If that's your reason to buy into gold, then it's probably not a good asset class. However, if you're actually genuinely interested in how it might be a non-correlated investment, if you're genuinely concerned that you might see inflation go up, or you might see it as a good alternative to the fiat currency, then absolutely, those are some good reasons to own gold, either the physical, the miner, or the ETF. Those are all some great ways to do it. So understand and know your why. Before I move on, I do want to just end this poll or reset this poll. I want to know, if you own gold, what type of ownership do you prefer? Do you prefer to own the physical asset? Do you own the miners or the ETF? I'd love to know a little bit more about how you own gold and how you access gold. So let me know in the polls feature. Let me know how you own gold, or if you would like to own gold, what way you would like to own it. Would you like to have the physical bar or coins in your hand that you can actually touch and feel and put under your pillow, or do you want to own the miners? Do you want to be able to have that mining stock approach, or buy the broad-based index, ETF index, which would track the price of gold? Or is there another way that you want to do that? Let me know in the poll. I'd love to hear more about that. Where does it fit in your portfolio? We kind of talked about this again. Recognize emotions. Just what I said before. Understand the why behind it. I got a call. I'll use this as an example. I got a call from a client. I don't remember the exact time frame, but it was in August, I believe, of 2018. It came out that that Oprah Winfrey was buying a huge position, large part of the company, of Weight Watchers. and Weight Watchers stock went shooting up. Boom, it was the best investment ever. It jumped to, I think, $26 a share. Is a beautiful thing. Every outlet was covering it, from Bloomberg to CNBC to the Wall Street Journal. Everybody was covering what happened to Weight Watchers. And I got a call from a client that said, oh man, I think I'm going to buy Weight Watchers. And he has this individual portfolio that he manages on his own. It's this kind of fund money. And I said, you know what? I don't think that that's the play to make. However, if that's what you feel is, you want to do. Well, unfortunately, he made the I call it the sucker bet, and bought in really high, and then it tanked right after. Now, again, when I say recognize emotions, that was an emotional buy. He got the FOMO, he got the other part of it. So understand that that your emotions play a big factor in this. With the election coming up, there are a lot of people, and I got to be honest, with both sides of the aisle, whether you're a Republican, Democrat, or independent, there are people all over the map that are freaked out about what's going to happen. The Republicans are worried that Biden and Kamala Harris are going to take this country into socialism, and then on the other side you've got the Democrats saying that Trump's going to rip this country apart and that we're going to be a shell of ourselves and all of this stuff, and we don't know who's right or wrong. And so with that, we're starting to see people buy into gold because it just feels safe. It feels like the safe asset class. We've been told it's the safe asset class. We've always had a relationship of gold. I saw a quote that gold is the 2,000-year-old bubble, investment bubble, that it constantly has these periods of rise and fall and rise and fall. And it's all relative as far as the price is concerned. But we have to be considerate that that gold is, like I said, a commodity, and it's very volatile as an allocation to your portfolio. So with that said, if you do decide to invest in gold, what is the allocation? What should you be invested? Do you do 50%? Is it 30%, 20%, 5%, whatever? I will say this outright, that my strategy does not incorporate a lot of gold and precious metals. Part of that is because it is a commodity, that it's volatile for all of the reasons that I've already brought up to this point. But oftentimes what we see is somewhere between 3 to 7, maybe 5 to 10% of a portfolio. It would make sense in gold or some sort of a commodity, precious metals types of approach. But that's a little bit of a loose cannon as far as that's not necessarily my recommendation, but it comes down to the individual situation. Depends on your portfolio, depends on how much money you have, and what you want your money to do for you. Again, if you need money to be very productive to generate income, then gold's not a real great asset class because it's a non-productive asset, as I mentioned before. So the allocation, there's a number of things. If you just Google, as an example, how much should I invest in, what's percentage of my portfolio in gold? I saw something that I think is rather absurd, and that is 20% of your portfolio should be invested in gold. And I thought, to me, that's just a little too much of an allocation. I'm not a big fan of that. But that's where sitting down with an individual like myself, I'm a certified financial planner, and so I take a planning first approach. So I'm going to walk you through, why do you own this? How will you own this? All of these things that you can figure out, and we can do this, on a one-on-one, customized, individualized perspective. So with that, use the offer button to connect with me, request that one-on-one call. You'll be taken to our website, plug in a little bit of contact information, how we can get hold of you, and I'll reach out to you, and we can put all of these conversations into context and say, if you want to own gold, let's figure out how we can make that work. And then I want to just throw this out there. How does it compare to the stock market? Because that's oftentimes what I get, is that people are going to sell their stocks to buy gold. They're going to buy gold to sell, and all of these things. They're going to sell their gold to buy stock. They're just going to be in and out. But what I find is that if you're going to own it, maybe do it in a broad-based approach and do it in a diversified approach. So how does that compare to the market? Gold versus the Dow Jones over the last 30 years. So again, 30 years, this is going to show kind of what you've seen as far as a percentage increase. I will point out, in this Gold is going to be the gold or the yellow orangish line, and the Dow Jones Industrial Average is going to be the blue. I am, again, not suggesting that you go out and invest in these two asset classes. I am saying that comparatively speaking, and using the Dow Jones as a metric or a proxy for investing in the stock market. These are going to be that. What we've seen is over the last 30 years, we've seen a almost 1,000% increase in the Dow Jones compared to about a 400% increase. So do you want 10x or 4x return on your investment? You'll notice that through the 90s and 2000s, you actually saw a negative return on gold. And oftentimes what you see is this goes back to our kind of putting it in context. And that is typically during these expansionary moments. Now, it's not always a guarantee, but through these expansionary or economic expansions, you see gold tend to do worse than the market. So again, just by saying, I'm going to get rid of my stocks and go into bonds, or I'm going to get rid of my stocks and go into gold, or I'm going to get rid of all of those things and go into gold, that is not a wise choice. All right. Gold can be a great part of somebody's portfolio, but it doesn't necessarily have to be everything of your portfolio. And so with that, we've kind of come to the end or a conclusion of the actual presentation here. And I want to just kind of address a couple of things. And that is, Larry had mentioned a question, and that is, what do we expect from the perspective of inflation over the next few years? He said 5 years. What is my take on that? Well, the reality is that I think over the next couple of years, to 1.5 to 2 years, that we will likely not see a huge amount of inflation. Part of that is I think that we're still trying to figure out what this whole coronavirus is really going to do. So if anything, we're going to see some contractionary economic indicators that say that we're going to be pulling back here. And so with that, we oftentimes also see sort of either stagflation or some deflation that can typically happen. But maybe coming in 2022, that's when the Fed has said, in their minutes that would likely be the earliest point that they would start increasing rates. And so with that said, that would likely, if we kind of go back, over the last 10 years, the Fed starting with Bernanke and then Janet Yellen, and then now with Jay Powell, they've really struggled with inflation. I know that under Yellen, that was something that was always she had like 2.2% was kind of the target, and that was always something that we're pushing at. But my hope is that with that, and I use interest rates and inflation kind of in the same context, because those are two things that kind of can get tied together. Is that with that, we'd likely see rates low through into 2022. But my hope is that they don't make some of the same errors maybe that you've seen. As an example, 2018, I think they made a little bit of an error increasing rates 4 times through that year. I think that had a bit of a negative impact. You saw that with all 3 asset classes that I've kind of talked about. Commodities did poorly that year, stocks did poorly that year, and bonds did poorly that year. Actually, 2018, the best producing asset class as a whole was cash. So that's certainly something to be considerate of. And then in 2019, we actually started reversing course and lowering rates. So I don't really like this Jekyll and Hyde approach to interest rates. So my belief is that once 2022 hits, we're going to start to see a little bit more of a gradual increase. However, that's all in the face of what's going to happen with inflation. If we see inflation really get aggressive, then we might see a faster or a higher momentum of interest rates. So those are some things there. I'm going to just jump back in the chat box and see if there's anything left as far as questions. I'm looking here. Linda, thank you. You've got a small percentage of your assets in gold and silver. It's been very interesting. So yes, thank you for sharing that. And that's oftentimes what I see is that a lot of times clients will come in and they have less than 5% allocation. So if you are one of those individuals that has a lot of questions about how to own gold, how to own precious metals, whether silver's good for you, whether you want to go real rogue and go palladium or maybe platinum or copper or something like that. They do say that copper. I saw this sort of this joke earlier. Is that copper has a PhD in economics, because what they say is that when we're seeing an expansionary environment from an economic perspective, copper does really well. Part of that is that it's part of the very heavily part of the home building process. A lot of we have copper lines, we have copper this, copper that. And so with that said, copper really could be a leading indicator. So if you have questions about how precious metals or some of those commodities might fit into your portfolio, this is a great time to check out the offers tab. Use that and click on that. Schedule a meeting now. It's a totally free meeting, 15-minute call. You'll have that with me. I'm a certified financial planner and wealth advisor, so I can give you a lot of holistic view of what's going on, how this might fit into your portfolio specifically, and understanding how it fits in the context of your portfolio and in time. If right now is a good time to buy, or maybe you hold off when we start to see sort of this bust, if that might happen in the next few months, or maybe it's right now is a great time to buy. These are all things that we want to consider. There's a great way to connect with us. You can follow up with us as a replay, and you can see all of our past episodes at presidentialwm.com. You'll see a tab up in the top that says webinar or webcast rather. You can see all of our past episodes. You can also email us at webcast@presidentialwm.com. That's a great way to connect with us as well if you have questions. Or you can always call our office directly at 303-694-1600. Again, thank you for watching Eagle's Nest webcast. My name is Taylor Leary, a certified financial planner and wealth advisor with Presidential Wealth Management. And thank you for joining us today. I look forward to connecting with you in the future.
Presidential Wealth Management securities and investment advisory services are offered through Forta Financial Group, Inc., a registered broker-dealer, member FINRA and SIPC.